So last quarter, we anticipated that accelerated vaccine distribution would spur reopenings, increased economic activity, higher inflation, and strong corporate earnings. And indeed, that's what has come to pass. We have seen the reopenings. Obviously, economic growth has rebounded strongly. The Conference Board now forecasts the 2021 GDP growth will hit 6.6%. The S&P 500 appreciated to right around 8.5%. So good stock market performance as we anticipated. Of course, we saw sharply higher inflation, and that's something that certainly caused some consternation among various market observers and commentators. But I think we're pretty much in the camp that these are, along with Federal Reserve Chairman Jay Powell, that this is a transitory period, and that once we start getting past the initial demand surge, which is undoubtedly stressed supply chains, we'll start to see that come back down again. The question now is obviously what's the outlook for the future, and I think that most of those expectations are going to be driven by what happens with inflation and interest rates. And so we continue to focus on investing in the best companies built for the long haul that we anticipate will provide outperformance over the cycle.
2020 saw corporate credit spreads widen significantly in March and then tighten throughout the year. However, 2021, we've also seen some volatility with spreads widening in the first quarter, but then reversing in the second quarter, most pronounced in the long end of the curve. So longer dated maturities performed better with yields falling the most. The Sextant bond income fund was able to take advantage of some of this yield curve movement by actually extending duration during the second quarter.
The first half of 2021 has set up a battle of competing forces, and we expect this will play out over the second part of the year. On one hand, you have continued inflation concerns, a workforce that is rapidly adding jobs, and high personal savings rates, all of which could end up pushing the economy to become overheated and the market to expect a more hawkish Fed. On the other hand, you have eviction and student loan payment moratoriums coming to an end this fall, a workforce participation rate that is still well below pre-pandemic levels, and the potential that having been scarred from the pandemic, savers actually sit on their cash rather than stimulate the economy with consumption. And as this battle plays out, we'll be actively collecting clues and positioning to take advantage of the prevailing wind.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting sextantfunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Sextant Funds in a free prospectus or summary prospectus, please visit sextantfunds.com or call 1-800-728-8762.